Welcome back to Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We've been reporting live from inside ETFs in Hollywood, Florida. And joining me now is Bruno. He is the managing director and CIO of IndexIQ. Thank you very much for joining us at Inside ETFs.
Thanks for having me.
We're going to talk about strategically implementing factor-based ETFs. And in which direction is smart beta heading, and particularly with fixed income?
Right, so when you're talking about smart beta, it's important for people to understand what we're talking about. So as it relates especially to fixed income, we're talking about taking apart standard fixed income indices and putting them back together, basically looking at the different factors that are driving the risk and the return to try to achieve a little bit of a different risk return profile. So if you take, for example, your Barclays Aggregate Bond Index, it can be broken down broadly into 5 sectors. You have investment grade corporate bonds, you have mortgage backs, and short, intermediate, long-term treasuries. And you may want to add some high yield in there. So if you take those apart and split them out into different pieces, you can recombine them in different ways, basically using a factor like momentum to help you achieve a slightly different risk return profile. And that's really what we're talking about with fixed income smart beta.
Right.
And we think it's still relatively new to the investing public. So if you look at equity smart beta factors, ETFs that sort of track those number in the hundreds, and the assets are in the hundreds of billions that track on the equity side. On the fixed income side, there may be 30 industry-wide, and the assets are significantly smaller. So we still think we're in the very, very early stages of where fixed income smart beta is.
What characteristics should investors look for within a product if they want to get into smart beta fixed income?
So for us, it's all about construction and education. So understanding how the factors are defined, how they're measured, and how you're actually constructing the portfolio is critical. And then education, really understanding what is this meant to do to my portfolio? Where does this fit? Why am I using it? And what environments is it likely to work well? And in what environments might it lag a little bit? So really understanding why it's put together the way it is, how it's put together, and how it's used all encompasses that education piece, which we think is critical.
And where should investors look to allocate?
Well, we're very positive still on high yield, despite the fact that we've seen spreads come down. So spreads are the yields of the bonds over individual treasuries with the same maturity. They're hovering near historic lows. However, we think people still need income. So we're still seeing money flowing into high yield. One of the common factors that we've looked at to try to isolate is volatility. So taking a high yield bond index, splitting it in half and owning the lowest risk bonds, the 50% lowest risk bonds, may be an interesting way to try to participate in the high yield market, still get much of the income, or to protect yourself a little bit on the downside in case yields and spreads start widening back out.
I think we're going to hear a lot more about fixed income this year.
I think so.
I agree with you. Thank you very much, Sal, for joining us.
Thanks,
and traders, thank you for joining me. Stay tuned throughout the day. I'm Jill Malandrino, global markets reporter at Nasdaq.